It takes us to our talk of the tape. Our stock's still on solid footing. Let's ask Dan Greenhaus, Solus Alternative Asset Management's chief strategist. He's with me here on set today. Do you feel like they are? I mean, because we felt a little unstable over the last week or so.
Yeah, we've had a real good run. I think the oil story that you alluded to at the outset is something about which we should be aware. WTI, we just had the chart up on the screen, was just $70. Now it's $77. Obviously, a lot of that is going to be the geopolitical risk premium associated with what's going on in the Middle East. And that's obviously something to be aware of because retail gasoline prices have been trending down for some time now, obviously providing a bit of a boost to a consumer that's already doing quite well. If these higher oil prices stick around, that may throw a little bit of a wrench in the works.
I mean, so we're debating the road ahead for the Fed. I've got yields up, maybe more so than people thought they would be since they cut by 50 basis points. I've got the Middle East is a problem, obviously. Now I've got another hurricane that I'm really concerned about because it's on the heels of the other one, which has already wreaked havoc. And, you know, it's done in and of itself some damage in the markets, too. What am I supposed to do with all that? I thought the trend was still up. I thought I was supposed to keep my eye on the ball and focus on the fact that we're cutting and the economy's good. Do I need to figure out some different things now?
No, I don't think so. I think both of those stories still remain in place. Obviously, the human tragedy of the hurricane that already hit and the one that's on the way is separate from markets. And obviously, our hearts go out to everybody affected and soon to be affected. But from a broader economic standpoint, not much changes in the wake of either one. The story in the Middle East is a different story because that's what's really driving up oil prices. Now, the positive side of things, and what do I mean by that, of course, is that the ever-present threat for now is that Israel chooses to use this moment to strike either a refining facility, a production facility, something in Iran, which takes some of Iranian barrels off the market. Some of that can be filled by Saudi and broader OPEC spare capacity, but it's something that's a more immediate issue for markets.
What do I do with the fact that yields are up? I'm not sure people had gamed out that, okay, the Fed is going to cut by 50 and they're going to continue to cut, and yields today are going to be higher than they were before the Fed cut.
Yeah, well, listen, in both cases, what you're, at least certainly in the short end, the issue right now is that some of those additional cuts that the market had overpriced are coming out. You had Brian Belsky on in the halftime show, and any number of people have made this observation as well. The market was way ahead of itself. The Fed Fund futures market, the Eurodollar market, way ahead of itself in terms of pricing the number of cuts that was likely to come. Not because the Fed wasn't signaling that. In some cases they were. But just the broader strength in the economy. Everyone's been waiting for that to wane, and consistently we've not seen it wane. And in fact, obviously, the most recent jobs report bore out the idea that the economy is doing fine. So yields are going back up as a result of that. But I would stress that's for the right reasons. It's good.
Yeah, but I mean, yes, it's good because they're going up for the right reason. But in the same moment, does it threaten the bullish case?
Well, what it does do is, how do I want to phrase it? It leads to the diversification that we've seen and the rotation that we've seen. If you look over the last 3 months, and obviously that's broader than the most recent Fed meeting, the only sectors that have underperformed the S&P 500 is tech, communication services, and discretionary. And the only reason discretionary is underperforming is because Tesla and Amazon are the two largest holdings.
You said it leads to the diversification. Does it hurt the broadening out or the cyclical trade because yields are actually going up now?
No, I don't think so. I remember the whole idea behind lower interest rates and tech names, long duration assets, is the more, in terms of like a discount cash flow model, the more of your dollars that I'm discounting further out, the value of those are higher in a present value sense. But for Google, for Meta, for Apple, et cetera, they make so much money right now. It's not really a rate. The Mag 7 is not really a rate play from that story. It's the more esoteric, it's the more speculative tech names where you see terminal value. This is a little accounting-y for the audience, but those names get more attractive in a lower rate environment.
But I mean, it's not great for, you know, let's just say the small caps, for example.
No, it is not.